righty, what is going on, everybody? Looks like we are live. Markets are not happy today. Looks like those taco tweets are now market is no longer believing them and pumping on them. All right, let me get everything moved around so we can do a nice little screen share. And you guys can start throwing in any questions you have for me in the chat. Audio is good? Good. Thank you. I forgot to even ask. Falling knife scenario, maybe, could be. All right, let's take a look. We've got Bitcoin. Looks like we might have another bear flag here. Not the cleanest, but with that breakdown there beneath this trend line, and then today's came back up, failed against it. Looks like that might be some more downside action coming soon with Bitcoin. If that confirms, especially if it breaks below this support at 62,000, then I would expect it to fall to about 50, maybe 49.5. So we could have one more big leg down. I would be really surprised if it falls more than that. We've got some pretty decent support around that $49,000-$50,000 mark. But one more leg down there is entirely possible. Next up, we've got gold. Seems to be recovering, establishing a base here. This flush out that happened on March 23rd, a week ago. That looks like it could be the bottom, but again, I'm not anticipating the bull market to resume fairly quickly. I expect something much more similar to this time period, 2020 through 2024. Maybe not completely sideways, but I don't anticipate this thing running up again strongly anytime soon. And same with silver. And then we got the stock market. We got the S&P 500 here. The S&P 500 is down now just about 10% from the top. The top was right there. All right, so it touched 9.78% down. So I don't know. To me, that's close enough. Call it 10%. I think SPY actually did hit 10%. SPY shares, let's see, from top to bottom. No, same thing. Okay, 9.84. And then NASDAQ from the top down 12.8%. So that one's definitely in correction territory officially. Right here. Yep, 12.78%. And then the big thing that will, start breaking things is bonds. So we've got the 10-year yield is up to 4.3%. It briefly touched 4.48%. Got the 20-year came up and touched came up above 5% a couple of times. Same thing with the 30-year, touched just under 5%. So bond yields are they're just popping, and that will start breaking things. At 5% long term, the government is bankrupt. they can't pay that. They can't afford that. So we get some sort of the longer it stays high and the higher it goes, the more likely we have some sort of emergency intervention, QE, yield curve control, bank deregulation, whatever. Um, but I've been watching a ton of indicators, whether you're looking at like CTAs right now, a bunch of, I'm sure you guys have seen in the news, like it was on Bloomberg and stuff. CTAs are more short right now than they've been in a very long time. The last time they were as short as they are right now was the bottom of 2025 in April, and then the bottom in 2020. Um, Not a sign that the bottom is in like price wise, but it's a sign that the bottom is close time wise. Um, so so yeah, they're at this point, when you look at like unless you're an extremely short term trader, this is like we're in deal territory now. Um, lots of discounts across the market, really quality stocks at really good prices. Um, so if you've got some cash, you got some income, this is a good area to start picking up deals. All right, let's see. This is a question from Hollow Weights. When is buy time on the S&P QQQ? What level are you projecting? Um, I think major levels of support are good are good opportunities. So if we go back and we take a look at the chart, so I can pull that up quicker. Okay, let's go back to NASDAQ here. So I don't know if we'll actually get down to this level, but 22,000 on the NASDAQ for QQQ, that would be 500, let's just call it $540 per share. I think it's reasonable that we have one more big flush out there and we bounce off of that strong support. I would actually be pretty surprised if we fall beneath that. And same thing with SPY. That same level would be about $610 per share, maybe 609. And again, it's possible we don't actually get quite all the way there. But those are two levels where I will probably get pretty aggressive. All right. From Delphin, do you think we are at the end of a business cycle? Well, okay, a couple things. Number one, there's no such thing as a business cycle. There is a debt cycle, or the Austrians call it the boom bust cycle. And so the boom is the result of the artificial expansion of credit and credit aggregates, monetary, the money supply that is loaned into existence. And so that causes an upward spiral of prices increasing. And that malinvestment and the misallocation of resources that happens during the boom makes the bust inevitable, because the unwind has to happen when, the levering up makes the deleveraging inevitable. But that's only the case in a system that has some sort of anchor to gold, or some sort of hard money supply. The bust is inevitable there. If you instead have a pure fiat system, you can always stop the bust, or stop in nominal terms, just by printing enough to offset the deleveraging. Now, the problem with that is sometimes that unleashes a crazy amount of inflation. So when we got to the end of 2021, they could have just continued to print to stop that deleveraging, to stop that bust. We had, probably a technical recession there. We had the bear market in 2022, but that would have made inflation just get crazy out of control. So they allowed that bust to happen. They tightened, and it was because of all of the easing that happened during 2020 and 2021. So it's a boom bust cycle from monetary policy, from manipulating the money supply and credit and debt. There's a lot more that goes into that, pricing signals and, the savings pool and all that. We don't need to get into that right now, but understand that that's what's causing this. Well, when you then take a look at what's been going on recently, we're exiting the tightening cycle. Like, the Fed has continued to tighten until just a couple of months ago. So we're moving from a tight money and a tightening environment into an easing environment. We're expecting rate cuts in the future. They just started QE, not QE again recently. We're about to get bank deregulation. There are a lot of things happening both from the fiscal side and the monetary policy side that we're moving from tightening to easing. And so I would actually say the opposite. If you're calling it a business cycle, boom bust cycle, debt cycle, whatever, we're moving into the next phase of where we would expect nominally a boom, not a bust. Okay. I will get to your guys. I will get to as many questions you guys are throwing them in. Keep on throwing them in for me. Just know that I will get to them. I'm not going to skip any of them. Um, and so don't, if I haven't gotten into it yet, I just haven't gotten to it yet. You don't have to throw it in there twice. I'll get to it. Okay. From Innovative Substantial Solutions. At what price would you short oil? I don't know if I would actually short oil, especially just based on price. Energy has really, really high short interest right now. Like XLE has a record amount of short interest right now. I'm bullish on energy companies overall. In my trading program, my commodities one, we have heavy exposure to energy. It wouldn't be based on price. It would be based on how the rest of this thing unfolds. Because let's say hypothetically, we do get a really quick resolution. Just, America goes in and annihilates and has a complete and utter, just decisive victory and win in Iran, get everything that whoever is pulling the strings, get everything that they want. And like you think about what happens after that, it's not like everything goes back to the way that it was before. Every day this goes on, the kind of the systemic effects, the longer lasting effects of the higher oil prices get kind of more deeply embedded. So it would depend on how this thing gets resolved. I don't see any realistic situation anytime soon here where I'd be like, all right, now it's time to short oil. All right. From Roy Sherwin, are Micron and SanDisk oversold? Google's new compression algorithm and SK Hynix will be available to U.S. investors soon. I think, okay, so they're very, very, like you can't put those two in the same bucket. Let's pull up the chart. So Micron has a PE ratio of 16, and SanDisk has a PE ratio of, what is that? It's not showing on here. What is their PE ratio? Well, is it because it's not 12 months yet? Because of when they split from Western Digital? Let me see if I can pull it up. MU PE ratio. No, sorry, not MU. SNDK. SNDK. Forward-looking estimates. That doesn't seem correct. I don't have it right now, but as SanDisk overall seems significantly more richly valued than Micron. Micron right now is like the lowest, especially it's the forward PE. It is like one of the lowest across the entire sector, and in its class, like by far, it's very, very undervalued in my opinion. Especially compared to all of its peers, it's sitting in a really, really nice spot. SanDisk, I actually exited. When did I exit? Earlier in March. I think it was somewhere around the 625 range is when I exited SanDisk. I'm still long Micron. So yeah, I personally don't think that they belong in the exact same bucket. And I'm just positioning wise, that's why I share with you guys whether I'm long or short something, just so you know whether my opinion on something has enough weight to cause me to take action on it. Obviously, I'm talking my book, but now you know those opinions, whether or not they have any skin in the game. So I think that Micron probably, yes, oversold. SanDisk is probably somewhat fairly valued. We'll see. All right, from Gear Grind, what are your thoughts on the MACD crossing for the S&P 500 if you look at it through a 20-year time rate? Hmm. I don't have that on my chart right now. It'd take me a bit to set that up. Mm, I don't know. Sorry. I wasn't prepared for that question. Don't have that on my chart right now. All right, from Steve Bishop. Wouldn't it make sense to do a call on SPY once we get close to major support? Sure. Yeah. The problem is if there is kind of widespread agreement of that opinion, like I'm going to wait till it bottoms, or it looks like it's bottoming at a certain support level, then the likelihood that it actually gets there is lower. Um, and so that's the difficulty with timing these things. The other thing is it's um, pricing in kind of like worst case scenarios of what's going to happen or what could happen. And realistically, any day that could actually flip and change fairly quickly. And so you'll likely see it, kind of show up on the chart, but this is a news driven market. You know, not so much driven by just the technicals. All right. From Delphin, fear level high, good time to get greedy. In general, yes, just be aware fear can last and get more fearful. And so as long as you are okay with the fact that if you buy something on sale, it might be more on sale after you buy it, and you're okay with that because you still bought it on sale, then just as long as you have proper expectations going into it, that it's not a bottoming indicator. Um, What's the best deal? Just QQQ. This is from Josh Pettiger. QQQ is a good one. SPY is a good one. Those are just good ways to get exposure to the deals. I really like Micron. I really like Amazon. I really like energy. Although I would say energy probably doesn't have as good of deals because they've been popping throughout all this rather than falling. Um, Quality companies. If you can say, hey, I'd like to buy this company and I'd be okay buying this with 10% of my net worth. And um, even if you're not going to do that, you'd be okay putting 10% of your net worth into something, even if the market were going to just shut you out for the next 40 years and you wouldn't be able to sell no matter what happened. Those are the kind of companies that are probably, regardless of what their price has done recently, especially if they're down, those are the kind of companies you want to be looking for. All right. Let's see here. Next question is from 13S print user. Assume Brent crude stays at 120 for at least the next 30 days. How does that impact the U.S. economy, U.S. inflation, and U.S. housing through the rest of 2026? Um, in the short term, it doesn't affect us as much. The longer it goes, the more it starts to affect it. Like it impacts other areas of the world in the short term far more than it impacts the US. But the longer it stays up there, the more it starts to affect us. And it's like you said, it's everything. It's because oil is like the input to everything. Like you don't have your iPhone without oil. You don't have, your headphones. You don't have the computer. You don't have the delivery of your products at your house. You don't have your house. Like the building and the making and the materials and the delivery and the transportation of literally everything Oil is at the foundation of that. So it's just everything gets more expensive, number one. And number two, if you don't have an increase in the money supply to compensate for that, then you don't actually get broad-based inflation of everything. You get a redirection of purchasing power. So other things get purchased less because the things with demand inelasticity, meaning I have to keep buying the same amount of food, I have to keep buying the same amount of gas to get to work, I have to keep buying, like, there's some things that don't have elasticity in their demand. You buy those with more of your money, and you buy the other things less because you have less money. It's more of it's going over there. And so you get more, at least closer to recession activity, as a result of all that purchasing power being directed to something that just suddenly got a lot more expensive, and we can't buy less of it. Okay, let's see here. Next question is from Trey5003. Why did you stop suggesting I trust capital? I feel hyperinflation around the corner when the dollars come home. Wow. So much to say about that. So number one, I did not stop recommending I trust capital. Well, you said suggesting. I did stop suggesting it because I stopped suggesting every company. A couple of years ago, I don't know if you've noticed, I haven't done a sponsored ad placement on my YouTube channel since I believe the year was 2023 was the last year. Was the end of 2023, I think. Might have been the end of 2024, but I think it was 2023. Anyway, I stopped doing all sponsored partnerships on my channel. There's no I don't promote anybody's company anymore. The number one reason for that is just because A, I didn't really like doing it. And B, from a business perspective, I make more money when I promote my own business rather than other people's businesses. And also, I found you guys didn't really like it either. When you look at the watch time charts on YouTube, anytime there was like a sponsored ad placement, the watch time would just drop off a cliff. So sometimes that was people just skipping ahead and then watching the end of the video. Sometimes that was people just clicking off the video and stopping watching the rest of it. So just all across the board, it didn't really make sense to keep on doing that. Now, I still use iTrust Capital. I still like them. And when people ask me, I recommend them. I do more recommend Swan Bitcoin now instead because they're only Bitcoin. iTrust Capital is a bunch of different cryptocurrencies, and I don't like any cryptocurrency other than Bitcoin. And so between the two, if I was going to pick, I would always pick Swan Bitcoin. They're more streamlined, easier. I think the pricing is better, a little bit. I think better security, systems overall. Although neither one of them has ever lost any customer assets or anything. But I don't have anything against iTrust Capital. Hyperinflation when the dollars come home, that one's a little bit of a misunderstanding about the way that the global monetary system works. There's not really a mechanism for all the dollars to come back home, at least not quick. And that's because of dollar denominated debt, meaning like companies and organizations and countries have borrowed dollars. And that's how dollars come into existence, is through borrowing them. So the more dollars that exist overseas in other countries, the more future demand there is for those dollars that I have to go find a way to get dollars to pay back the debt that I owe. And if I default, those dollars cease to exist in the system. So that's actually deflationary. Now, the caveat to that is if there's a big deflationary death spiral deleveraging event where there's defaults of dollar denominated debt that start rapidly spiraling through the system, there's big entities that just have no ability to pay it back all at once. Likely what will happen to deal with that crisis is the central banks on top of those banks, if they have any dollar reserves, they will use those to do a bailout. They most likely don't have enough, so they'll have to tap the swap lines and get new dollars from the Fed. And then those debt assets are replaced by actual liquid dollars, and then those can cause some inflation, be distributed, and do whatever. And so then you have potential for some big inflation events. But right now, that the fact that there is that all those dollars around the world have come into existence through being lent into existence means that there's more demand for dollars than dollars exist. A lot more. That's how the fiat monetary system works. Okay, the next question is from Heisenberg. Where do you see underpriced value in the market right now? I mean, all over the place. The indexes are just a good place to start. Amazon is probably one of my top picks for that. You guys know if you've been following me forever, I've been talking about Amazon for a long time. Micron is another one that looks really good right now. Even Nvidia, even though it's huge, valuation wise, it's not crazy. It's pretty decent actually. There are quite a few. And then just the top good long-term holdings that have been seeing kind of a sell off, like Berkshire Hathaway looks pretty good. Let's see here. Costco's probably kind of expensive at these levels. Yeah, those are the names that pop into my head. All right, let's see here. This is from Daffy D. With increased oil prices in a war economy, wouldn't commodities do well? Yeah, that's why I have an entire trading group dedicated to commodities and resources and energy and materials. Very well. All right, from I2 Guru. Be nice to pick up treasuries at 6%. Likely we'd get a pullback in a few years for a nice capital gain while getting a great coupon. Yeah. I don't know if they'll get that high because I think they could. If they do, some stuff is breaking. Some stuff is breaking for sure. But yeah, because worse. Like if you just have to hang on to them, then you don't get those gains, the capital gains. You're still pulling in 6%. But likely they get that high and intervention has to be made to push those prices down. I'm sorry, prices up, yields down. Let's see here. Question from Medium Close. What do you suggest for an investor near all-time highs? Somebody who's 95% cash, 5% bonds. Do you have a scaling into the market strategy in this environment? Okay, just to be honest with you, this is my opinion. I'm not telling you to do this because I don't know you or your situation. I don't know how close you are to needing that money, how close you are to retirement, like what your income is like. Right now in my situation, if I was 95% cash, 5% bonds, I mean, personally at this point, I'd be all in very quickly within a matter of days. Like if you look at some of the most conservative, good investors, you're looking at like Berkshire Hathaway, Warren Buffett. They're 30% cash. So you're infinitely more conservative and scared than Warren Buffett is or Berkshire Hathaway at this point. And so the allocation that I really like is 30% stocks, 30% real estate, 20% gold, 5% cash, 5% Bitcoin, 10% for active trading, speculation, hedging. And so of the stock allocation, yeah, I'm personally going to be going all in. Now, if that scares you, like the point of building wealth is to increase the quality of your life. So if going all in and buying a bunch of stocks and not having that safety cushion makes you not be able to fall asleep at night, that means that the wealth is not doing the job. And so, one thing you can do is purchase and then hedge, count the cost of hedging, so that okay, I've baked in let's say a 10% loss. Worst case scenario, my base case is I just lost 10%. Um, and then just write it out from there, like buy some real long-term puts. If you don't like that, then you can also sell some short-term calls like every single month that are out of the money to try and eventually you'll pay for that put. It'll probably, if you buy it, let's say a 2-year output, it'll probably take you like 1 year of selling calls to bring in enough income to pay for that put, and then you have free protection from there. If it spikes, you get called away, so you want to make sure you're selling calls at a price that is at least break even. Where if it spikes up and you get called away, it's like at least a 10% gain. That way you don't lose from the put, or you just keep the put and you get right back into the position after you get called away. And basically then you've structured for yourself a bond, limited downside, limited upside, income along the way. I mean, that's basically structurally what a bond does for your portfolio. The other thing you can do is just say, okay, well, let's say I've got 100 grand. I'm going to allocate a certain amount into stocks over the next, pick a time frame, month, 2 months, whatever is comfortable for you. And either do it on a daily basis or do it on red days. Like, hey, if there's a big red day, I'm going to buy more. And I'm going to wait for another red day and I'm going to buy again. And I'm going to wait for another red day, then I'm going to buy again. It is unlikely that you will do well staying in cash for the long term, given the amount of inflation we are likely to see over the long term. And so you are sitting on a paper, you're sitting on a pile of paper that is slowly burning. You're probably burning less than what the stock market is doing right now, but that's short term. Long term, at some point, you've got to get back over into the game, or else you'll just slowly watch all that purchasing power bleed away. All right. Question from Cade Wilcox. How might someone deploy dry powder in this scenario? Is it okay to deploy most of my cash reserve during this slump? Okay, I basically was just answering that question, and it depends on what you mean by cash reserve. So if you mean the part of your portfolio that you were setting aside for buying deals, then absolutely, like that's what this is for. Doesn't mean you're gonna be like, you might see stuff more on sale and you'll be kicking yourself, oh, I should have waited. But you might see things just go up from here. And then if you waited, you're like, I should have bought earlier. So you'll never be able to time it perfectly, and just expect that. Expect that you will have a regret of not being able to time it perfectly, because it's impossible. If you're talking about like your emergency savings account, absolutely not. That's for you to rely on in a worst case scenario if you need to replace your income. So definitely don't touch something that's not part of your investable assets, your portfolio. Your emergency savings account is separate. Your 6 months reserve or year of reserve, whatever you have set aside, definitely don't touch that for investing. But in terms of in your portfolio for your overall investing, you've got your cash allocation, you're looking at deals right now. That's what that's for. All right. Next question is from Alex, Alexion Reeve. What is a good quality stock that you like in the energy sector at the moment, or any others you prefer? Really like Exxon. Really like Bloom Energy. Really like URA. Really like MGY. What else? Those are probably my favorites right now. And those are all positions that I actually have. So just so you know. All right. Question from trying to find the next question here. Okay. This is from One Vad. Too much financial markets info is giving me a headache. Have you considered buying some land and growing your own food? There's a reason why everybody who owned their own land and grew their own food moved to the cities during the Industrial Revolution to work in coal mines and factories, because subsistence level survival is very difficult and suffering. And so if you actually have to be completely self-sufficient, it's not a full-time job. It's like 3 full-time jobs with no breaks for the rest of your life, or you die. So the way to mitigate that is to create some wealth and then supplement the little hobbies that you want to have with the 1 cow and the 2 goats and the 5 chickens and the couple rabbits, just because you enjoy that lifestyle. And then you have money to buy everything else so that you have some quality of life. But actual subsistence level living is something that humanity has been trying to escape since the beginning because it is suffering. So if you are not in a position to be able to do that out of hobby and not necessity, then you're probably setting yourself up for having to quit that lifestyle and start over with a more normal lifestyle. All right. From Gizorn, do you think the market risks Bitcoin devaluing, gold going down could lead to long-term bonds like TLT spiking? I'm long TLT right now. I think the short-term bullish case for TLT is fairly strong because the government needs yields down, long-term yields down. Doesn't have much to do with Bitcoin and gold, though. But I do like TLT right here. All right. Question from Pacho 808. What are your thoughts on DCAing, dollar cost averaging, into precious metals this year? I've been slowly acquiring COPX. That's a copper mining fund. I'm also looking into deploying into SLV. Yes, my opinion, take it slow. It's not urgent at all. I think precious metals is at these prices, they're going to be choppy and volatile for a while here. I don't think we're on the precipice of another giant bull run. We already had that. And so I think we'll have a good amount of time here to be able to accumulate whatever position you're trying to accumulate and take advantage of big red days, take advantage of the volatility in the dips. So I don't think we'll go significantly lower from here. But gold tends to move in big bull runs and then sideways choppy volatile actions for a while. Those big bull runs precede easy monetary policy, and then they start moving sideways before that easy monetary policy actually starts to hit. All right. Question from Volga Vanna White. What are your thoughts on fertilizer potash as a potential investment sector? Yes. Bullish. I like it. I do have one position in that area. So I am bullish. I like it. Yeah. All right. Question from, that is a bot or spam. Trying to find the next question. Okay. From It's Barrages. Do you think the markets will ever go through a Great Depression again? Do you think having something like that is the reset we need from all the money printing? No. And the reason why is because the Federal Reserve, after the Great Depression, kind of like there was a while, it was like, that's in their opinion, the stain in their legacy is not printing enough to, have prices go up enough to compensate for, everything else that was pushing prices down. That, in their opinion, is like their biggest mistake. Now, knowing history and knowing real economics, like if you've ever read the book, The Forgotten Depression, the reason why the first Great Depression in 1920, 1921 resolved itself so quickly, even though it was incredibly severe, it resolved itself in 18 months, is because the government balanced the budget. They spent less. The Federal Reserve raised interest rates. 18 months, fixed itself, and we entered the roaring 20s. Now they made this same mistake again after that. They made everything super easy, new credit, bubbles and a big false boom again. And then they tried to ease their way out of it, but they just didn't do it quite enough to push prices up. And yeah, it made it, especially with all the fiscal policy, everything the government did, made it last incredibly long. So the answer is I think no, because they will always do at least enough easing and printing in order to stop the nominal collapse. And then the flip side of that is they'll probably just cause inflation. But they'd rather have that than deflation. Deflation is the boogeyman to the Fed. They will do anything and everything within their power to not let that happen. Okay. Question from BWTV. As a beginner trader, would you shoot to double the S&P 500 or just slightly beat? Definitely don't try and double it as a beginner trader. As a beginner trader, go into it with the expectation of, for the first 2 years, not only will you not beat the market, you won't match the market, you'll lose money. More, even if the market is down, you'll lose more. And so if you're especially if you're trying to trade for income, like for full time, you need to be able to have a savings account that you live off of for 2 years and you don't touch your trading account. And hopefully that's not the case, but like, just have that expectation and go into it with like, I'm paying to learn these lessons about how to do it well, and how to, I'm going to make a mistake. And as long as I pay attention and I keep track of what I did, I can go back and look, okay, I was doing this strategy. Maybe I was cutting my gains too soon. Maybe I was cutting my losses, not soon enough, whatever the situation is. You have enough data, you go back and look and you can tweak it. You stick to it, you'll learn and you'll start to beat the market eventually, but not as a beginner trader. Just expect it'll take a while and it'll be expensive. Micron, a good buy right now. I like Micron. I'm long. Question from Mango. What are a few companies with good long-term economics trading at low prices after the sell-off? What opportunities do you see as of now? I've answered that a couple of times, but for those of you who are just on, even just the index funds right now, I really like SPY, QQQ. All the big names are really reasonably valued right now. My favorites are like Google, Amazon. Amazon's probably my absolute top favorite of everything. Micron. Yeah. Question from BTC Hop, Bitcoin Hopper. Great to see you today. Can you look at ET and Opine? I picked up 22 strike calls expiring in January 27, what I thought looked pretty cheap. Okay, ET, and you picked up the 22 strike calls. Let's pull up the chart. Energy Transfer LP, you picked up the 22 strike calls. All right, so 22 is right here. Let's put a line there so we remember. All right, looks like we've got some pretty good resistance here at the 19-ish, somewhere 19 to 20-ish range, somewhere in here. If we can break above that and hold, we do have a little bit more resistance here at this recent high of, this 21.42, but not too strong there. I wouldn't expect it to be too hard for it to break above that, especially with all this momentum. If we do break above that, though, it's kind of smooth sailing up to probably 31, maybe 30. So if you paid for those 22 calls, let's say you paid $5, then I would say getting out when they're worth $10. That's probably a good, that'd be like the minimum for me to enter into, like for a trade. I want them to be asymmetric in terms of my potential loss versus my potential gain. If you bought them for, let's just say hypothetically they were crazy expensive, they were $8, then that's still an okay trade depending on where you plan to get out. So buying something for $8 for a plan to sell it for $10 is fine if you plan to sell it at a loss when that $8 becomes, let's say, $7, because then you're risking $1 to make $2. So that's still asymmetric. So there's plenty of ways to make sure that you're never risking a large loss, whether that's on the exit, whether that's through pure position sizing, whether that's through the potential profit. There's tons of ways to do it, as long as you're making sure it's, in some way you are risking a smaller amount than you have, the potential to make. I would imagine, though, they were not anywhere near that expensive. And so yeah, this chart looks good as long as we can break above that. If we don't, we might see the time frame here sounds good to me by the beginning of next year. We've got some really good upward momentum here. This sell off here found really good support at 16, and then we came back up. So yeah, chart looks good. I'm sure the fundamentals is energy transfer. This is ET, $67 billion company, oil and gas. Yeah. Yeah. I like it. Assuming, of course, depends on what you paid for it, but sounds like you got a good price. Jason Jones, I have a question. Can you see this? Yes, I can. Good question. Hope that helps. Christian from Christian Nog Hernandez. Would you buy TLT right now? I'm long TLT right now. I've got an open call position on it. So yes, I would. I'm not you though. So again, I know you guys probably get tired of people saying this. You just have to say it. I'm not telling you guys what to do. This is not advice. I'm not making a recommendation to you. I'm just telling you guys my opinions and what I'm doing. All right. Question from Bauman Sales. Why does gold keep going down? Because it went up like 150% in 2 years and had a blow off top, and it anticipates monetary policy. Now now it's anticipating the opposite side of that. And also it's being used for its purpose. It's being sold like Turkey sold an insane amount of gold over the past couple of weeks. And so it's being used as, a global monetary asset. It's serving its function. All right. Question from Augmented X. For someone who wants the simplest investment long-term portfolio, 60% VT, which for those of you who don't know, that's the Vanguard global stock market, basically every stock, 20% gold, 20% short-term treasuries, which is an emergency or high yield savings account. Essentially, is this a good approach? It's definitely not a bad approach. There are much worse approaches that I've seen. I like the fact that you specify short-term treasuries, like a high yield savings account type of thing, instead of like long-term treasuries for like a long-term portfolio, because they won't typically yield more than the real rate of inflation over the long term. Like the vast majority of the last 100 years, 10-year plus treasuries had a negative real yield. But using like T-bills or a high yield savings account for a portion of your portfolio, it's more liquid. It's less likely to be impacted by, the unrealized losses. And it still has, at least right now, very similar yield. And in my opinion, you can use that to make purchases when things go on sale. That means, in my opinion right now, I would be lowering that allocation and increasing the allocation to the things that are on sale. But if it helps you sleep at night, that's the point of building wealth, to increase your quality of life. So if you won't be able to fall asleep at night because you have 10% in T-bills and 70% in stocks, then by all means, use your wealth in a way that's going to increase your quality of life. And then the 20% gold, that'll be a really good chunk of your portfolio as well. I like 20% gold a lot. All right, question from Lastic55. If you need liquidity now, you selling gold or VOO? Depends on what you need the liquidity for. It depends on what you need the liquidity for. Like if you're trying to, if you see some stocks that individual stocks that you really like, then you're not changing your overall allocation, asset class wise, by selling some VOO and using that to buy some individual stocks. If you were looking at your portfolio and you're like, I'm way out of whack, like I've got percentage wise way more gold than I should, or way more stocks than I should, you can use that to like rebalance. And then if you're using it for like individual expenses, emergency expenses, something like that, then you look at, again, which area you're overweight in your portfolio right now. All right. Question from Productive Dude. Thank you for the super chat. Really appreciate it. Thoughts on URA, long and short term? For both long and short term, I'm bullish. Definitely long term, more bullish, because it got sucked down in this sell off with kind of everything else. We were headed higher, and with everything else, it kind of got pulled down. So probably some more headwinds that it's going to be facing. But yeah, I'm long URA. I really like it. Definitely a good position of mine. Okay. Question from okay, where's the next question? From Mini Stick Snipes. Where do you see USD CAD going? Isn't there going to be more demand for CAD because of oil? Maybe. I don't have a strong opinion on USD versus CAD. I am bullish on the DXY index. I think over the next couple of years, it's headed higher. Specifically against CAD, I don't know. Don't have a strong opinion on that. All right. Question from Fuzzy Dunlop 148. What are your thoughts on Christian Zionism? As a born-again Christian, I cannot find supporting text in the Bible for the modern state of Israel. I could be missing something. Okay. When in the Bible, Jesus spoke in parables a lot, stories. A lot of people think he did that in order to make it easier to understand his point. Like he was doing it as like a teaching method. When he was asked why he spoke in parables, he specifically said, I do this so that the people who I don't want to understand what I'm saying or to hear my message will not be able to understand it. But the people who are following me and are paying attention and are like working hard at trying to figure it out, they will be able to figure it out. So it was intentionally done to not let the people to kind of hide the message. I'm going to do that right here. I'm not going to plainly answer your question directly because my business relies on me being able to continue to talk to you guys on platforms like this. Before Jesus came on the scene, there was one place where the Israelites could go to get two things: miracles, like get healed from sicknesses like leprosy or whatever, and forgiveness of sins. There was one place, and that was the place where God's dimension and man's dimension crossed over. There was only one place on earth where God's dwelling place and man's dwelling place were the same. That was the temple. And the place where God's dwelling place and man's dwelling place crossed over, the temple, was where you could go to get your sins forgiven and where you could go to have miracles happen, like get healed. Jesus comes on the scene and he starts going around and doing two things: miracles and forgiving people's sins, saying, I am the place where God's dimension and man's dimension cross over. I'm the new temple. He said, there will come a time where it does not matter where you worship. That one physical place is no longer going to matter. Physical places no longer matter. Later on, we read, we are the temple of the Holy Spirit. There is now no longer Jew nor Gentile. These old categories have been done away with. The whole point that was missed was that he was a Messiah coming for the entire world, and not as a political, military, geographical leader like everybody expected. The reason why they put him to death. The whole point was that the new kingdom was to spread to the entire world for everybody, and that it no longer had to do with a physical place, a physical temple, a physical location, or a bloodline. That's what I'll say about that. Okay. Question from Jason Jones. What are your thoughts on MMT, modern monetary theory? Man, okay, so I've never deleted a YouTube video unless there was like a major glitch. So one time I put up a YouTube video and half the video was black. You could hear me, but you couldn't see anything. So I deleted that one. But other than that, I've never deleted a YouTube video just because I feel like there's like I don't know, like an ethical thing to it. Like I said it at the time, even if I disagree with it now, I'm leaving it up. And part of that is like a lot of my original YouTube videos were pretty bad. I was not that skilled at recording, editing, coming up with thoughts and clearly articulating them. I did a whole video on Stephanie Kelton's book, The Deficit Myth, I believe. And I was trying to debunk everything from that book from a first principles level thinking, like, let's peel back all these layers that she's kind of distracting with and go to the root of what she's actually saying. And it's thinly veiled, communistic, kleptocratic wealth redistribution, justification for using some true math equations to say, therefore, we can just take people's purchasing power and hand it to other people and everything will be better. Things like government's deficit is the public sector surplus. Well, guess what? My deficit is the rest of the public's surplus. That doesn't mean it's a good thing. That's just an accounting truth. If I spend more money than I make, that means everybody else on net makes more money than they spend to me. Like, so what? So it's just garbage. There are a couple little like accounting truths in there that they use to try and convince people that straight up wealth redistribution through the printing press, which just takes purchasing power. They conflate wealth and money completely in order to justify wealth theft and transfer. So not a fan. However, you might not know that from watching a lot of my recent YouTube videos because I try to talk more about the way things are and what is happening and what is likely to happen rather than what should happen. Because I can sit here and complain all day long about they shouldn't be spending as much money as they are. We shouldn't be running these deficits. We should have a sound money. We shouldn't have, all these problems that we have. That doesn't really do any good. So I've tried to focus a lot more lately on here's the way that things work. Here's what is likely to happen. Like, here's what the Fed is likely to do so that we can be better prepared for that rather than focusing on what should happen. Because to be honest, it's not helpful. Yeah, there's a lot of things that should happen, but that doesn't help me prepare for what is actually going to happen. All right. Okay, this isn't a question, but Bobby Sanders said markets in turmoil at down 10%. Brother, what? LOL. Accurate, 100%. However, that's the indexes. That's the indices. Many stocks are way more down than that. Much more. Especially the ones that a lot of people own. Many stocks right now are down 20, 30, 40% or more from their highs. Stocks that were like the best performers of 2025. are down a crazy amount right now. Um, and so just because the overall index is not down that much doesn't mean people's portfolios aren't experiencing that pain. In fact, that can actually make it feel worse because the market drops 1%, your portfolio drops 2 or 3% or more. And you're sitting there being like, just feeling like you're alone in that pain, like you're the one getting blown up and everybody else is fine because the market's only down 10%, but you're down way more. And so the overall index might not be in turmoil, but a lot of people's portfolios feel that way. All right. From Z Stabs, are we going into stagflation in 2026? And how do you hedge against that? Well, if things keep on just chugging along the way they are right now, then yeah, close. The problem is to get stagflation, um, we need on in general, all prices go up. So you need just enough money printing to continue supporting purchasing power across the board, even though some things got way more expensive. Um, but not enough to cause like a nominal boom. Um, Kind of hard to pull that off, actually. Also, last time when we had stagflation, um, the debt to GDP ratio was nowhere near what it is right now. It was like 40% and dropped to like 30%. Our debt to GDP ratio is 125% right now. It's the same as it was post World War II. So they can't afford the policies that allowed stagflation. They have to deal with paying but with financing the debt. Question from B Stancil. Really, you believe the S&P 500 index looks good right now? It depends on the time frame that you're talking about. Um, if you're talking about the next couple of days, maybe even the next week or two, then probably not. We probably have more pain in the short term. But it's very difficult to time the exact bottom, and trying to do that likely means you miss out. Like the best days in the entire market history, the largest green days in all market history, are the days that immediately follow the bottoms. They're like the day and the second day after the exact bottom. And so it's very difficult to time that. And if you try, then a lot of times you miss out on those best days in the market. And then you start chasing it higher. So personally, I'd rather be early than try and wait and time it perfectly and then miss out. But there's nothing wrong with taking the opposite approach. All right. Question from Mr. What to Do Today. Thoughts on QQQ rule change to fast track OpenAI and SpaceX? Feels like retail bag holding. Yes, partly. So I don't know as much about the structure of the things that they're trying to do with OpenAI. From what I understood, most of the rule changes were being done for SpaceX, and the rule changes are being added to the index after early rather than waiting for the certain amount of time. The amount of shares that are actually available for float and the weighting of that. So the weighting rules have like minimums, and by weighting I mean WEIGHT, like the size, how much what percentage the stock makes up in the index compared to how many shares are available to actually trade. And because SpaceX is planning on having fewer shares like available, like below the minimum, it gets weighted higher than it really should. So it funnels a bunch of money from the index to juice the shares. So it could, with SpaceX, it could be some bag holding. It could also just be I guess what you would call like financial engineering, that it's not it's not a definite like dump on retail. It could very well be something that just because of the rule changes and the way it's being done helps the stock get pumped higher, and then maybe takes a dump later, but maybe not immediately. Um, do I think that's ethical or moral? No. But again, I try not to focus on how things should be. Try to focus on like, okay, what is likely to happen here? Because then we can play it. All right, question from Taprack. Buying a bond position right now seems like it's guaranteed to lose. What would you use in lieu of a bond allocation right now? Well, the any cash allocation behind the scenes at some point, you peel back the layers enough, you get to a bond position. You've got cash in a bank account, behind the scenes, that's in treasuries. You got cash in a savings account, it's in treasuries. You got cash in a money market account, it's in treasuries. You got cash in a 401k, that's in treasuries. So the question is not, I mean, you really can't stay out, have zero exposure to any bonds whatsoever, because even like the moment you get paid, now you're in cash. Um, so to me, I think instead of trying to avoid it, I try and just structure it as well as I can. So for my cash position, keeping it in money markets or high yield savings accounts, so where it's or T bills, so that it's higher yield than just zero, but liquid enough where I can actually use it if I need to or want to. Um, and then for the portion of my portfolio that traditionally they would put in like bond funds, to me that's what I use mainly gold for, because gold over time has a positive real yield most of the time, and especially over over the long term. Um, and again, it doesn't actually yield anything unless you participate in like gold leases or gold lending. Just like the price performance, it generally just keeps track with inflation. Whereas bonds generally underperform compared to inflation. All right, question from Lewis Morin. With Fannie Mae now accepting crypto as mortgage collateral, what will that do to Bitcoin? I don't think anything. I don't think anything. For the price of something to move, anytime there's for the price of something to move, there has to be transactions. Anytime there's a transaction, there's a buyer on one side and a seller on the other. So the only reason a price would move is if all the buyers are willing to pay higher and higher prices for that thing. Because sellers are always going to be willing to accept higher and higher prices. So it means the buyers are willing to pay those higher and higher prices. On the flip side, if the price moves down, it's because the sellers are willing to accept lower and lower prices, because the buyers are always willing to pay lower and lower prices. So Bitcoin being used as collateral for some mortgages is unlikely to have any meaningful impact on the price of Bitcoin. Okay, question from Nicole Wong. What does your stock allocation look like? What percentage tech, etc.? Um, good amount tech, good amount commodities, energy, materials. Um, good amount insurance, a little bit of healthcare. Um, some retail. I mean, nothing crazy. Fairly well, fairly well spread out. All right, from Edge Structure, what is your take on Oracle right now? Let's pull up the chart. Oh, brutal. This is what I'm talking about. We were talking about earlier. Oracle's down 60% from September of 2025. So that was 6 months ago. I mean, that's a brutal sell-off. But this is one of those companies that might be justified. their moat could be legitimately threatened and shrinking. Cloud and license hardware services, enterprise applications, infrastructure technologies. Same thing with like Adobe. Yes, they're still making really good money. I think their earnings are still increasing, but markets markets are future discounting machines. In other words, I'm not I'm not buying something for what it's doing right now. I'm buying something for what I think it's going to do in the future, or I'm selling something for because of what I think it's going to do in the future. And so that's all valuation is. It's looking at a money printer and you're saying, okay, well, I know it prints out $100 bills every day right now, but there's a good chance that in a month it's only going to be printing out $50 bills, or in a year it's only going to be printing out $10 bills. And so I'm not going to pay for it based on the $100 bills it's printing right now. I'm going to buy this thing based off of the $10 bills I think it's going to be printing in the future. And so I'm only going to be willing to buy it if I can buy it for a much lower price. Similarly, you look at a stock that's just been doing super well. You're not buying it based off of what it's printing right now. You're buying it based off of what you think it is likely to continue to do in the future. Like, yeah, it's printing $50 bills right now, but next year I think it's going to be printing $100 bills. That's all valuation is. And so, yeah, Adobe, Oracle, maybe. Oops. Like maybe they still had, good earnings, and then they sell off because the market is trying to discount into the present what the future is likely to hold, not really based on what's going on right now. Okay. From Hollow Eights, with 30% real estate, do you also include REITs? Technically, yes. I personally don't like REITs because some of the main benefits for real estate are the tax benefits, with the depreciation. Um, Depending on the property that you have, you can do cost segregation studies and get bonus depreciation to if you have extra income that you need to offset. The leverage that is not available anywhere else, like you can't get a 30-year fixed rate mortgage on a REIT. You can get a margin loan, but it's variable and it's not going to be as good of an interest rate. Uh, so there's advantages to physical that you just can't get with and also the pricing. Like a lot of because they're in it's public markets with so much more money, so much more scale. There's a lot of that profit potential has been purchased up and arbitraged away. There's a reason why Berkshire Hathaway is not running around buying up single family homes. And it's not because you can't find them any that'll cash flow really well right now. It's because it doesn't move the needle for them. They could get a 200% return on a $10 million market cap company, and it wouldn't move the needle for them. They're looking to deploy $100 billion. So they, even if it's a lower percentage return, they're trying to find places where they can deploy a lot of money. And so anything that is at scale enough, like, some of these larger REITs, you have a lot of money chasing that prices out. It's basically worse returns usually than if you're able to pick up good single family properties. But just for exposure to the space, yeah. All right, question from question. Man, there are so many comments in here that I haven't gotten to yet. I am way behind. Sorry, everybody. It just popped to the bottom. I'm not going to be able to find where I was. I think there was a super chat in here that I missed too. Yeah, from Taprack. Thank you for the super chat. Really appreciate it. Let me see if I can find where I was. All right. What do you think about the financial sector after the sell off? Visa, Affirm, FinServe. Visa and I think MasterCard, I really like. I don't right now have a position in those. I've been watching them. I am thinking about building a position there. Affirm, I'm not sure because they're like the buy now, pay later ones. And those I seem like they're the highest risk. Like if we do get into trouble, like those are the ones that they're going to be defaulting on. Um, but a lot of the financial sector looks good right now. There are like zero stocks um, in XLF right now. I think it's XLF that are above their 50-day EMA. Let me see if I can find that stat. Found it. Okay. Pull it up. Okay, 0% of S&P financials are above the 50-day EMA. So the last time this happened was the bottom of the almost the bottom of the bear market in 2022, but we did have a local, a rally from there. The time before that was near and then at the bottom in 2020, and the time before that was the bottom right before, at the end of 2018. So down here you can see every time that's happened, what the returns are following a certain period of time. So anything up to 1 month after this happens is usually fairly split. But once you get 2 months out, 100% of the time, you're green. And that's for the overall S&P 500, not just for financials. So once you get to this point where 0% of financials are above their 50 EMA, then your 2-month performance plus is positive every time, going back to 2018. So it's things like that, man. It's like, yeah, we could still have some bleeding from here, but looks like we're getting close. Okay. From Christian Ibanez, what software do you use to edit your videos? I use a guy named John. No, I think my editor uses the Adobe products. But he's been experimenting with DaVinci, and we've used Final Cut Pro in the past. All right, let's see. Question from B. Stancil. It stinks being censored based on your real beliefs, based on some platform. I don't view it as censorship. I view it as being shrewd, being clever. In 2020, I saw a lot of people speak the truth and unnecessarily get shut down because they was taking a stand and saying all the words, and then some of them never were able to. Some of them were able to get back and get their channels recovered and get back online and whatever. A lot of them weren't, especially some of the smaller ones. And I think it's more important to get the message out to the people who matter and be able to continue going rather than try and take some, moral high ground. And I'm going to say the things bluntly. Just because I feel like that's the thing that it doesn't do as much good, in my opinion. Okay. Next question from Bitcoin Hopper. Did I hear that the government bought 10% of Intel, or was I hearing things? It was a while ago. They took a 10% stake in Intel sometime last year. It was a while ago. Yeah, guys, I'm way behind on the comments. I'm trying to get to all of them, but it keeps on popping around. I haven't been able to catch up yet, which is a good thing. I really, really appreciate the fact that you guys are throwing in all these questions for me. I know it's been a long time since I went live. And I'm definitely like, I appreciate it. I just feel bad for you guys. So you throw a question in and it takes me forever to get to it. So the recording will be up for this after. And I have a clips channel now, Heresy Financial Clips, where we take as many of the questions as possible and post them as clips. So you should be able to find it there if you can't stay on the whole time. Okay, question from Gizorn. Have you ever reviewed investing as a corporation instead of individual to reinvest gains before it becomes profits, so you only pay tax on earnings taken out rather than year over year? Yes, briefly, and there are a couple issues with it. So, here's the first thing. You can do anything you want. File it the way you want, and then pay whatever taxes you think you owe. And most of the time, unless you're a super big fish, you'll probably be fine, meaning nobody will find out. And so because of that, there are a lot of idiots giving terrible, illegal, not maybe illegal, whatever, like gray area tax advice, telling you to do things. And a lot of their clients end up being fine. But the one time somebody gets an audit, they're destroyed. And so part of the game is because the Internal Revenue Code, it's long, but it's not explicit on every rule. For a lot of things, you actually have to look into the case law. Like you have to look at the tax court results when somebody gets audited, how the rulings happen, so that you know, okay, well, this isn't explicitly stated in the Internal Revenue Code. So how am I supposed to do it? So a good example of this is the real estate professional status. So there's a tax thing that people want to do where I buy real estate, it has depreciation. So paper losses that are more than the income the property produces, I'm going to take those losses and apply them to my earned income. Sounds great. How do you do that? You have to be a real estate professional in order to do that. You have to qualify as real estate professional status, REPS. And so a lot of people out there, you look online, TikTok, YouTube Shorts, whatever, a lot of people are telling you, all you have to do is get 750 hours a year of real estate something, and then you can be a real estate professional and you can have that loss offset your income. And so they tell you, go to the seminars, review your financials, talk to your property manager, do all, and 99% of those things they're telling you to do don't qualify for reps hours. And so like education doesn't count. Reviewing financials doesn't count. Talking to your property manager doesn't count. Like, so they're getting 750 hours of things that don't actually count toward real estate professional status. And not only that, you also have a full-time job. So they were never told, if you have a full-time job, you have to do the other thing more than your other, you have to do the real estate stuff more than your full-time job. So if you work 2,000 hours a year, you don't need 750 hours to qualify for reps. You need 2,001 hours to qualify for reps. And so you only need 750 hours if it's the only thing you do. And so a lot of these tax gurus are not telling you how these things get settled in tax court when somebody gets audited. And so they're doing all the wrong things. They don't know it. Most of them are fine because they never get audited, but the one person who does get audited, they're screwed. And so some of these things are just playing it a little bit safe, whereas like, because it might be a gray area. Now, I'm not saying that your question there specifically was that. I talked to my tax strategist about that one time, and there was something about it's a possibility. I don't remember why we decided not to do that, but we decided not to do that. All right. Question from Julio Gutierrez. What's your take in data centers with or without Bitcoin mining? Pretty bullish. on some of them and completely staying away from others. So it's a case by case basis. I don't think it's a like energy. If I was just to say XLE, just don't pick individuals, just pick XLE, I'd be fine with that. Data centers, I think it's a completely different story. I want to go case by case and pick them out individually. Pretty much all of them right now, the big ones, they're all moving to AI data centers. They're moving away from Bitcoin mining because the profitability is gone. That means there's a really good opportunity for like the small miners because pretty soon the difficulty adjustment is probably going to go, it's probably going to adjust down because so many miners are going to be going offline. But yeah, case by case basis, there are some that I really like. All right.